We're early in earnings season, but it's a big week. 20% of the S&P 500 reporting. Investors have one eye as well on Brexit, on trade. What do you do in a market where the S&P 500 is swinging gently around 3,000?
Right. Well, I think you have to be sort of separate some of the developed market political risks, like Brexit, from some of the fundamental stories, and then recombine them in some coherent way. And it's very difficult, of course, right? You know, when you look at things like Brexit, you could have the 10 most brilliant analytical people in the world all staring at the same data, trying to get a trade on, and it's a little bit like they're just staring at a roulette wheel, right? We just don't know. You can't get edge on this there, but you have to sort of recognize that sort of this persistent overhang is part of that. Having said that, on the fundamental side, you know, the earnings, my view on earnings here is that they're going to be one more pretty good quarter, right? You know, earnings estimates for the quarter too low, for prospectively 12 months forward, they're too high. I think the buy side has already figured that out. And so it's, to a certain degree, I don't want to be dismissive, but unless there's some massive surprises in the tech sector, I'm going to guess the earnings season is going to come in an almost uninteresting way again. Right. Some beats, some decent forecast into the future with all the caveats that, you know, trade can take us in all sorts of different directions into 2020.
So what's the strategy? Invest and protect?
Well, I think you have to step back for a second and look, the defining thing in the U.S. equity complex this year has been a huge rally with against a backdrop of a massive bond bid, right? That I think caught many of us, myself included, by surprise. Within this equity rally, SPX up 20% more or less year to date, there's massive polarization. And if you look at equity pairs, sector pairs within the equity complex, for example, Russell Growth or Russell Value, the tech sector versus financials, the correlation of those pairs with the 10-year Treasury yield is at record levels, like correlation coefficients of 0.8 or higher, right? And so to a certain degree, every sector rotational bet you might make between now and year end is a rates trade. So you have to have a context, at least, if not a view, for what might happen with interest rates.